So who does Michigan play next, Chris?
We got Arkansas State this Saturday, so that'll be a little bit easier game certainly than Texas. And the week after that, which I'll be going to, is against USC. So that'll be, with all the conference realignment, there's a whole lot of teams that are going to be playing each other every other year that used to be you only played each other once every 10 or 20 years. So a lot of new stuff going on. Now actually the Pac-12 that they were down to two teams, they've now announced they bring in six over, I think, from Mountain West. So all the conferences are kind of just pillaging each other now.
The Pac-12 is 8 teams. The Big Ten is like 70 teams.
The numbers don't matter anymore.
Did you buy stock in airlines, given all the travel that all the West Coast teams are going to be doing from here on out?
Yeah, really. Well, and you think about, football is one thing. Football has lots of money and resources and stuff, but there's most schools have 28 varsity programs, right? So, and there's going to be a whole lot of extra travel for a whole lot of extra programs that don't fit into this we play once a week kind of thing, right? There are programs that play 3 times a week. So I can see that being a real pain for a lot of the other programs, but apparently football and cash is king.
It pays for, I think, all that travel, but it is going to be interesting to see the post-mortem, 8 months from now, 20 months from now on. Yeah, women's lacrosse, USC traveling to, Penn State to play. And it's it's crazy because, as you mentioned, how many athletic programs these schools have in the Big Ten.
All right.
All right. This is the big picture. We'll give everybody another 30 seconds or so, and then we'll go ahead and get started. Your Lions, Chris, good opening win. Browns, great start to the season for the Browns.
Well, the NFL does a good job of finding some storylines too, right?
Yeah.
Matthew Stafford, former quarterback. We're gonna have a rematch again. They do a really good job with that.
It's better than the Browns storylines right now. That's for sure. So it's just the worst possible start to the season for the Browns possible. Just destroyed by the Cowboys and fresh Deshaun Watson lawsuits.
It was only the 27th lawsuit, I think, though, right? There's not a whole lot of them.
Oh, God help me. All right. Welcome, everyone. This is The Big Picture. I'm Rich Swerbinski with Onward and Upward Consulting. Thank you for joining us today. And as always, join my esteemed colleague and co-host. Is that a Zoom background, Rob, or you on the side of the road? Or
I hired a marketing firm for $3,000 to design backgrounds for me, and they came up with 92 Corolla.
Okay. So that was the marketing firm I referred you. All right, good to see they're doing good for you. All right. So, and this week, really pleased to be joined by a recurring guest on the show, one of our favorite guests, and somebody we dial up when the bond market rates are the soup du jour. It is our guy from Vice Capital Markets, their founder, Chris Bennett. Chris, great to see you today.
Hey, same here. Thanks so much for having me again, guys. I really appreciate it. Always enjoy it.
No coincidence that we scheduled you right after Michigan had the Texas game on the schedule. But I can't even talk smack to Michigan fans right now, honestly, until we get that horrific monkey off our back. I don't even have it in me.
It looks like a good year for you guys.
Don't jinx us. Everybody said about the Browns. And so anyway, but and as always, please, your comments, questions, any feedback, please feel free to pump it into the chat with Q&A, and we will incorporate it into the show. So, Rob, Fed meeting next week. I'll just lay it right out. Usually I have these long, convoluted questions for you. 25 or 50 basis points next week?
25.
25 basis points.
For those gang signals, or okay, all right.
It's like the Spock.
Yeah. That's signs. Next, I'll be holding up a newspaper with today's headline, just to proof of life.
So the CME Fed Watch, as of just a few minutes ago, 71% chance of 25 basis points baked into the markets, 29% chance of 50. But any expanded rationale before we get to our subject matter expert, Rob, on 25 v 50 next week?
I just don't. I view 50 basis points as just somebody sent me a statistic. A broker pal of mine who recently moved from New Jersey to Florida, sent me a statistic that he saw, which I didn't check, which I thought was an exaggeration, but maybe not. That the average Fed during a business cycle, the Fed raises rates by 20 times, and lowers rates 20 times on average in each cycle. And I thought, at first I thought that's just that's just totally ludicrous. And I thought, well, let's see, 20 times a quarter, that's like 5%, 5% up, 5% down. So that's probably reasonable. But in this case, I just view a 0.5%. I just don't think the economy needs that much stimulation to raise overnight or to lower overnight Fed funds by 50 basis points. I just don't see it. I just don't see the economy faltering. I think we've had a nice gradual bond market move, and property values are holding in, and the economy is doing okay. It's not like unemployment is shooting up. It's not like anything's going gangbusters. And in fact, inflation's moderated. It's pretty steady. So yeah, 25 basis points. That's just my 2 cents. Rich, what do you think?
I think it will be 25 next week. I don't necessarily agree with that. They've been certainly more critical of the Fed over the years than you. And, hey, inflation is transitory, and 5-6 months before really they saw the light, they saw the writing on the wall. So the dissenting opinion, the 25, would be, Fed late to the party, raising rates. We've got a lot of revisions of data, a lot of smart people making arguments with and without data that the jobs market is not as healthy as even the revised data would suggest. And, are they going to be slow on the come down, late to the party once again, would be, I guess, the dissenting opinion. But Chris, what say you?
Certainly some big data revisions, right? I mean, a lot of people may not know this, but the big employment report that comes out every month, we gained 125,000 jobs, we gained 175,000, whatever it is. The BLS, Bureau of Labor Statistics, once a year goes and reviews it all, because these are done from surveys and that kind of thing, and says, hey, we got a lot more information. What do we think the numbers really were now that we have a lot more information? And of course, as you guys both know, they revised it downward, the total number of jobs gained by 800,000. That's a big miss, right? And if the Fed had that information, 800,000 jobs, that's 60,000. Being off by 60,000 a month is a lot. So instead of 180, you got 120, which I think also explains why over the last year we've had decently healthy gains in jobs, but an unemployment rate that's been slowly ticking up from 3.4 to 4.3 and down to now to 4.2, which is still a very low unemployment rate, right? They kind of say anything below 4% really creates a lot of labor market pressure. Because 4% is pretty normal. You've got 6 million people looking for jobs. Sorry, I need 6 million people, and then 6 million people that are 6 million job openings, but they don't all mesh together because they're not all a good fit for each other. So that's very normal unemployment. So to be below that really puts a lot of stress in the labor market. So even though unemployment's gone up by almost a full percentage point, it's still at a really very healthy level. The whole 25 versus 50 thing, I've thought since June when the last dot plots came out of the Fed saying, here's our projections, the summary of economic projections for later this year. And then they said, we're expecting 4 quarter-point cuts in 2025, 4 quarter-point cuts in 2026. And again, this is just what they think, if all the data comes in the way that they want it to. It made sense to me that it would really take a big thing to happen for them to adjust that picture, especially to do 50 basis points at the first meeting. I thought the bar was really high for that. And a lot of it, the reason I think is that the Fed cares a lot about their legacy, how they're viewed. They like to have a very slow and steady hand. They certainly were late to the party in terms of raising rates, right? And you could make the case that they were late to the party in cutting, but I think if they raised so much, they kept it up high, and now their first cut is 50, it really hurts their credibility. It makes people think, oh, we told you so, you were behind the curve, you didn't do your job right, and now you're panicking. And it's the last thing they want the market to think. So that's why I thought the bar to go 50 is really, really high. So I think if you said the odds right now are 71 versus 29, I think the people that are betting on the 29% chance are going to be losers in that bet.
Yeah, I agree 100%. You can torture these numbers till they scream, till you find something, some little something. But yeah, Chris, I agree. You know, the Fed does not want to be viewed as having some kind of knee-jerk reaction. That's what happened. Remember, of course you guys remember, what was it, a month ago? We had the 6-hour refi boom. And all of a sudden everybody was talking about, oh my God, the Fed needs to have an emergency meeting and cut rates. And I said, no, they don't. Yeah, it's not the Fed, you know, looking at a one-day stock market performance or bond market performance is not enough to warrant a change in the Fed's attitude toward interest rates. And so, yeah, I think 25 basis points and on top of that, Rich, I mean, much to the possible disappointment of folks on the call, you know, I would say all of 25 basis points is baked into mortgage rates and baked into treasury yields. And you know what'll happen. I mean, I'm starting to sound jaded here. Now you really got me going. But what's going to happen is they'll come out on the 18th with 25 basis points, and then everybody will say, "What's next? What's going to happen next? What's the next unemployment data going to look like? What's the next CPI data going to look like? What's the Fed going to when's the Fed meets 3 more times this year?" I heard an economist the other day talking about, oh, he thinks there'll be 5 rate cuts this year, which caused me to wonder if I misread the Fed's open market committee meeting schedule. So I pull it up. They meet September, and they meet 3 more times this year. I doubt if they will change rates 5 times.
Well, good. Anyway. Good segue. There are 2 more Fed meetings after next week's, November 7 and December 18th. Ira, very fine secondary market mind in his own right in the chat. And yeah, I did check it, Ira, right before. Right now, there is expectation of 100 basis points by the end of the year. So basically 2 quarter cuts and a 50 basis point cut at these next 3 meetings. I'd say the conventional wisdom is 25 next week, 50 at one of the last 2 meetings, and 25 at the other one. But Chris, any, you know, the rest of the year, any insight, thoughts on, it's really one meeting at a time, right? I mean,
I think it really is. It's, you know, that they go on and on about it being data dependent. And it is data dependent, or at least it's data aware, right? And we're not there in terms of their 2% target for inflation. Depending on which measure you want to look at, it's between 2.2 and 3.2. But that's okay. We don't have to get to 2 to start an easing cycle. And really, it's not necessarily even an easing. It's just it's loosening the tightening. If I can make up that term, loosening the tightening, of looking and saying rates are overly restrictive for where we are. We've gotten to the point we were trying to break something. We were trying to ease all the tension off the labor market that was incredibly tight. The job openings compared to unemployment people reached a ratio of 2 to 1, actually 2.1 to 1, which is huge. Usually, normal healthy market is right about even of unemployed people to job openings, and that's come back. We've actually that ratio is back to pre-pandemic levels. So they've been successful in what they've done. What they have to be a little bit careful about, though, is that it didn't go too far. And because Fed policy acts with this lag, I think that's why, you know, they're going to start the easing cycle. And part of it is, you know, without them having actually eased once, market conditions overall are already eased because we have expectations for easings that are baked into the end of this year and next year and even the year afterwards. So it doesn't have to be necessarily about what is the Fed funds rate, but what are those expectations, and also how do those play into inflation expectations?
And what is a normal average Fed funds rate?
Well, I guess it depends on how far back you want to go, right? They used to, when the Fed would put out their dot plots, the SEP, usually for a long time, their long-term target or idea of what the Fed funds rate should be was usually around 2 to 2.5. Now, if you look at the median Fed voter and what they think, it's really more in the 2.5 to 3 or 3.25 type area. It's almost like we've really kind of, or at least to the Fed governors' minds and all their analysts and teams of all these, you know, folks with all these research, it's changed their long run expectations of where they think the appropriate level of the Fed funds rate is. Now, whether that's because we've had this bout of inflation. There's always a specter of inflation. Back in the 90s and even the early 2000s, we had much higher interest rates than we had right now because we had this horrible thing that happened in the 80s. We had 6% inflation in the 90s at times. So that was always hanging over people's heads. And all those, all that fear kind of went away for a long time in this last decade or so until the last few years. And that was resurged back a little bit. Maybe it's because of higher federal deficits. We've got more supply that's coming in, and that maybe not be changing anytime soon. But it really has changed. If you look at the average, it kind of depends on which decade, right, that you look. But it seems to have changed at least the Fed's expectations for what the neutral rate of the Fed funds rate should be. It's more toward 3% than 2%.
Got some inflation data this week, reaffirming really that inflation in check, CPI and PPI coming out this week, and inflation at a 3-year low on the consumer side. Really kind of a seminal moment as the Fed has been waging this battle against inflation for years now. And now within that, I think so. The markets have turned their attention to the labor market as it relates to Fed action and what they may or may not do. And I guess, Chris, how, 800,000 job revision. I don't know enough about this to get into the weeds on this, but I mean, when you're creating 250,000 jobs a month, I guess, in a healthy employment market. How can you be off by 70,000, 65?
It's a lot, right?
I mean, there's something is just, that is so, I mean, is it bad data? Is it hard to collect the data? Are they doing it the wrong way? How is that possible?
I think I know exactly what you mean. How is that possible? A good longtime friend of mine, I've known since probably the mid 90s, Stuart Taylor, the employment report, he used to always call it the employment lie, where the government issues their current lie for the month and revisions to their previous lies. And it's not a conspiracy, but it's certainly a very inexact science. They're getting all this data from sampling. They've got literally they're calling companies and finding out how many people did you hire, how many people did you let go or quit, and they're trying to get, because they can't contact every single company in the entire country. They've got these statistical samples. They're like, all right, we're going to get some of this industry and this industry and this industry. And here's how we're going to revise the data for seasonal tendencies. We know that retail hiring goes way up in November and December during Christmas. So those kinds of things. 80,000, 800,000 is still, it's a really large miss. And I haven't really kind of read the detailed explanation as to how it was that big. But when you get further on, and that's, they also revise those numbers, I think 1 or 2 or 3 more times afterwards. But the once a year they do the big revision. So I don't really know how you miss it that bad. I do think it certainly would have made a difference in the Fed being a little bit more willing to ease those tight monetary policies a little bit sooner.
Real world inflation update, Rob's McDonald's lunch, $11. We confirmed before we went live. So
it's also California, right?
It's California.
And I apologize. I always told my kids, don't eat in front of others if they're not eating, but it's lunchtime here in California in the Central Valley, and McDonald's fries are really good when they're hot, but when they get cold,
it's true.
Not so good. So I'm just trying to wolf this down unobtrusively. So
you're not going to get no stone casting for me on eating McDonald's fries, right when they get placed in the car. So
well, regardless of how many Fed cuts we have or when they come or what nobody knows or at least I certainly don't know how the economic numbers are going to come out. It's certainly a more exciting time than it's been in a long time to be in the mortgage business, right? We're going to actually have the Yahoo Finance effect with borrowers where, they're talking to their loan officer and they're making an application. They're like, hey, I just saw on Yahoo Finance that the Fed's going to cut mortgage rates next week. So we've got everybody, it's been since really 2019 that we've had this planned easing that hasn't been a pandemic generated thing. So there's going to be a lot of originators that'll have to kind of remember, or if they're newer to the business, they'll have to kind of learn how to temper those borrower expectations and educate people as to that's not exactly how it works. That all those assumptions are already kind of built into the rates that we have today.
That's interesting. You bring up a good point, Chris, because I always tell people or remind people when I'm speaking in front of a group, anybody who's been in this business 16 years, 16 years or less, wasn't around when Countrywide was around. anybody who's been in the business 10 years or less, they weren't in the business before the CFPB, was hitting its stride. And so the people now, if you've been in the business like whatever period of time or less, you've never seen a Fed ease. You've only seen Fed increases in rates. So it's a different conversation that like sales management has to talk to their newer loan officers, younger loan officers about, here's what's going to happen. We've seen it before, and pass down some of this muscle memory to people who haven't been in the business that long. So, like I said earlier, it's baked into the market, but loan officers, loan originators are going to get calls.
For
So
sure.
good. It helps those people sell the products, sell their service. Hey, I'm glad you called. Here's what's going on. And by the way, we just rolled out this new down payment assistance program, or hey, we've got this great HELOC or whatever it is. It gives people, originators, a chance to sell themselves. So that's a good thing.
Sure is.
So, I mean, assuming all data and news is neutral between now and next Wednesday, if we get 25, the mortgage bond market likely sells off a little bit, right? We probably get a little bit of increase in rates. If we get 50, we're 5.99 on a 30-year fixed, I think, right, Chris? If we get
and I think maybe actually more important than what the Fed does or doesn't do with the funds rate at this meeting is the new dot plots, the new summary of economic projections, where they're telling the market, hey, if all things come in like we think that they will, here's our expectations for GDP, for inflation, for payroll growth, unemployment, and of course, the one everyone in Bondland cares about of here's where we think if everything comes in the way that we expect it to, the Fed's funds rate will be in 2025 and 2026. How much do they revise what they put out there 3 months ago? Is it not revised at all? Do they revise it lower? I mean, to my mind, that's actually not just Powell's speech afterwards, but the dot plots, I think, are probably the story, I think, of the meeting that's going to come out next Wednesday. There's an interesting, we're talking to people about, the Fed not setting mortgage rates and what's the correlation there. One of the ways I like to explain it to people is, yes, it's all baked in terms of the market has expectations for Fed cuts in the next 2 years, but mortgage rates are going to be very similar to a 5-year treasury because mortgages on average last about 5 years. So if you look at a 5-year treasury as being made up of the sum of what's the Fed funds rate every quarter for the next 5 years. As we go through time, this 5-year treasury, think of it as like a Tootsie Roll, we're going to be starting to chop off and lose those pieces where the Fed funds rate is 5.5, 5.25, 5, 4 3/4, and adding on pieces at the end of the Tootsie Roll of the long run Fed funds rate of 3 or 2.5 or 3.5 or whatever that is. And so even though every quarter in Fed cuts isn't a quarter mortgage rates, of course, because it is baked in, that doesn't mean that over time we can't see the yields on that 5-year treasury drop, and therefore rates on mortgages drop as we get rid of those periods of time of high Fed funds rates and add in periods of time out in the future.
Chris, I have 2 questions. I like the Tootsie Roll analogy. Are you seeing pipelines? I mean, you have a wide variety of originators and you look at their pipelines and their positions every day. Are you seeing an uptick in business and locked pipelines down? Is it steady? What's going on with volume?
Yeah, I would say, I think it depends on the time frames you compare, but
no, like this month versus last.
Yeah, I would say pretty steady compared to last month, but then August being significantly better than July being better than June. When you kind of look at the, there's a great chart, which I just pulled it up, was taking a look at it, that was shared with me. It's from MBA, but it's on the number of refinance applications every month. And as we all know, the absolute low we had was, I think, the very end of 2022, mortgage refinance applications. And we're up now, we're 2.5 times that level. But if you expand this chart out 15, 17 years, the current level that we're at in refinance applications, while 2.5 times what we had 2 years ago, it's still lower than almost every data point going back 18 years. So, is it a refinance boom? Certainly not, but way better than it was before. And hopefully these lower rates will really help free up a lot of that locked in housing market that, we've all been kind of suffering through. We won't have a couple more, any other bleak winters like we had the last 2 years.
Did see an interesting stat today 5 Fed cutting cycles since 1990. Twice the Fed started with a 50 basis point reduction. Both times recession quickly followed. So maybe something else on the mind of the Fed. To John from Van Dyke, his point in the chat, the adjust and analyze approach that definitely the two of you are espousing, but and panic too. I do think that, 50 basis points next week would have some political tentacles to it potentially that the Fed probably wants to avoid, as well as panic, freaking people out, to Rob's earlier point.
Yeah,
Their legacy matters.
I'm the guy to go to when it comes to panic or trying to. After a while, you just kind of say, I was talking to Ira about this earlier this week. It's kind of like, let's just have a kind of a nice, steady, can't we all get along kind of market? Like, stock market's been kind of going up and down, whatever, but the interest rates have been kind of coming down, kind of coming down, kind of coming down. Let's just keep that up. Chris, volatility is our enemy. We don't need renegotiations. We don't need extensions. We don't need whatever. Let's just have a nice, steady, if rates are going to go down little by little by little, let's do it.
I'll vote for that, Rob.
Yeah.
Get rid of I always carry that. My Tums are right next to me on my credenza, so I'll eventually get rid of those if this keeps up. It's actually next to, so a lot of people on the call might not know this. This is a Rolodex.
Oh man, wow.
And I don't use mine anymore, but I've always kept it. So when I'm reading about, here's all this new technology that as soon as the borrower's rate drops to this, they get an email, they can click on something and apply for a loan. I thought about how back in the 90s, I knew several loan officers that their Rolodex wasn't all their business contacts. It was all the mortgages that they had done before where they had, name, loan amount, and interest rate. And they had their Rolodex actually filed by interest rates. So every time rates would drop, they would just turn to that section of their Rolodex and start making some calls. We called it dialing for dollars. So in honor of that, I've always kept my Rolodex, even though I don't know if any of these people are still in the business anymore.
I have a Rolodex. Rich, it would be interesting, Chris, to find out with those originators who had that clever, way of organizing a Rolodex, how many of them are still 30 or 40 years later originating loans?
Yeah. It'd be interesting. I bet a good amount. It's hard to say, right? There's a lot of people that don't retire. They sort of soft retire. They sort of just ease back in the burners a little bit. Especially when you have a case where, you don't need to go 50 or 60 hours a week because it's not that kind of environment, right? You've got a lot of past business, you have a lot of referrals, and you like to take care of the people that you like to take care of.
Right.
Chris, I'll start with you, go to Rob. Letter grade for the Fed, just overall, since starting with inflation is transitory to today, what letter grade would you give Jay Powell and the Fed board?
This is me?
Yeah.
I think I'd go with B minus.
B minus.
I think I'd go with B minus.
I'll say B plus.
B plus. Okay.
What about you, Rich?
The reason why I say that, well, we can defend our grades, but I think it's important for people I view these things historically, Chris and Rich, you guys have been around for a while. I remember back when the Fed was, a mystery wrapped in an enigma, shrouded in a, puzzle or whatever Winston Churchill called China. Alan Greenspan would come out and utter some statement, and everybody would be scrambling, trying to figure it out. The Fed now is very transparent. Every week they give dozens of speeches, and they say what's on their mind. And I think that the market has benefited from that. And so I like that about them. That's why I give them a B plus.
Yeah.
Yeah. They're only, and once again, I'll get off my stump here, but there's only so many things, so much that the Fed Reserve can do. They can't deal with a tanker that gets stuck in the Suez Canal. They can't deal with a drought that hits Kansas. They can't deal with something that happens in China with regard to trade. So they only have so much that they can do. And I think they've done an okay job, a better than average job, doing what they can do and influencing what they can. Enough. I'll have some fries now.
I think fair enough.
C- would be my grade. I just, again, inflation is transitory for 5 months. 5 months, I mean, including a couple months after it was obvious to most that what was going on. And again, I just think operating off of data that is just so flawed. And quite frankly, I think some of the data that we continue to get today, that you really have to take with a grain of salt, and that we could be looking in the rear view. That hey, and I agree, like 25 is probably the right move next week for all the reasons we've mentioned. But I just think we could be talking 6 months from now about late to the party twice. So we'll see. I really hope I'm wrong, obviously. So
Rich, a favorite question that I have for, when I'm hanging out with Doug Duncan from Fannie Mae or Mike Frantonius, what do you look at that is not a common economic indicator that you have found to be useful? And my guess is, I mean, the Federal Reserve talks about personal consumption expenditure, but I am sure all those guys, men and women, and the people who report to them also have other metrics that they look at. Maybe they're looking at shipping costs. Maybe they're looking at airline passenger miles. I think that they are looking at things that aren't mainstream unemployment, PCE, CPI. And I think that, we look at those things, but they are looking at a lot of other things that, we may or may not be aware of in order to gauge the
I
economy.
hope, because it feels a little to me like the renaissance that baseball went through with the Moneyball era, when, in all sports for that matter, teams were just, hey, putting 80-year-old scouts in the stands, and, other teams were just looking at different data in different ways. And, and to this day, I think teams that weaponize data, have had a lot of success. Front offices, I just, to me, it feels a little bit like that. And again, I hope I'm wrong. I hope they're looking at a lot of different things. I'm sure they are, obviously, but I hope they're not relying on the numbers we see as, the basis of, how they make decisions.
So I'm going to bring Chris back into the conversation here. Chris, without revealing too much about the Bennett fortune, I assume that you're buying up as many bonds as you can, knowing that rates are going to drop and bond prices are going to go up. True?
Well, back when, not I wouldn't say currently buying, but back when the 10-year yield hit 5%, that was the sweet spot for me. It looks like there's a lot of upside and very little downside. So it's kind of funny with a lot of financial planners, and I don't have one, but there's a lot of financial planners that probably 12 of my friends are. They too often have this philosophy of, well, bonds you're not really trying to make or anything. You're trying to just sort of be safe and conservative. And I look and ask them what they were doing, and they had 40% of their money in bonds when interest rates were zero. So I thought to myself, I've said to a couple that are good friends, I'm like, that's insane. You had 40% of your money in bonds when interest rates are zero. There's only one way they're going to go. So you were trying to squeak out this tiny little return on getting a 5-year note or a little corporate thing that paid 1.5% instead of zero. And you just lost 17 points when interest rates went up. So literally you lost 10 times the little tiny amount you were hoping to get. I always would kind of say to them, it's, I understand that, like, I'm not trying to pick as NVIDIA winner or this a winner or with that kind of thing, but it's okay to use your brain. When interest rates are zero, don't buy any bonds. When interest rates are high, buy bonds.
Great point.
Are you kind of the same? Are you the same philosophy?
Yeah. We could have a whole discussion about money management. A lot
Water
of my money,
stocks, water stocks.
a lot of my, that's true. People got to drink. But and baseball cards, right? Sports cards, limited editions.
That's right.
Pieces of fabric from game worn jerseys that, they're going to produce another 1,000 cards after the next game and the next game and the next game. Anyway, don't get me started. No, I agree. And I've I I have, a couple $1,000s in my investment portfolio, and I've shifted that into long-term bonds.
Yep.
So
Alan Greenspan came up earlier. He's still alive, amazingly. He's like 98, which is incredible because he looked 98 35 years ago.
back in 2000.
Still is alive. I mean, I'll go to both of you with another question. Favorite Fed chair of your life? Chris, I'll start with you.
Ooh. I think I like Ben Bernanke is my favorite. Just really because he's very tall.
Favorite Fed
is
chair.
Ben Bernanke's really tall? I mean,
the
compared to
beard.
Janet Yellen's, everybody's
Beard.
tall. How tall is Ben Bernanke?
Bernanke, I don't, yeah, I mean, he was 06 to 14.
No,
So
how tall is he?
I don't know. I mean,
I think he's in the 6'5", 6'6" neighborhood.
Really?
And then
Alan Greenspan's tall also, right? Or he used to be
I
before
think
he
he might have
shrank.
used to. He might have shrunk about 8 or 9 inches since its peak.
is Jay Powell since 18, Yellen 2014 to 2018, Bernanke 06 to 14.
I like Janet Yellen. She's kind of a no nonsense,
Yep.
person doing her job. And did she make it till 2018? And then Trump got rid of her.
Trump got rid of her.
Replaced with Jay Powell. Yep. I
Right.
always like the ones that when they go before Congress, they got to give their testimony and they get grilled, and in the end, the senators and Congress people they're really just sort of want to pontificate about their own thing for their constituents. And I love the ones that they'll hear this diatribe and they'll say, "Was there a question in there for me?"
All right, look at
I mean, I was gonna say I don't remember Bernanke being tall.
yeah, I don't either.
Was
I think,
freakishly
I think
tall.
Chris has been hitting the edibles before the call.
He's
He
really
did have an
5'8".
immaculate beard, though. The
I
beard
guess
was.
I'm just thinking about him next to Janet Yellen. Wow.
Well,
Paul
Yellen
Volcker,
is
I'm
tiny.
sorry.
I think Yellen's like 5 foot.
I'm thinking of Paul Volcker being 6'7". Thank you.
Yeah.
Nice job, Jeff.
Volcker and Bernanke and Greenspan, I think, were very tall. Volcker preceded Greenspan. Greenspan,
So what?
years as Fed chair, 87 to 06. I didn't realize that until I looked it up before the show. 30 years as the Fed chair. It's incredible. Or 20.
So
20.
Rich, sorry to direct the call here, but people are tuning in for mortgage information to some extent. Chris, once again, Vice Capital sees a large variety of clients, and you're looking at all this data. Any kind of trends that you've seen that have raised eyebrows in your staff, like, hey, I'm seeing a lot of this, or I'm seeing a lot of that, or boy, I'm seeing my clients making no money on VA loans and a lot of money on FHA loans. I mean, or ARM production is picking up. What are you seeing out there from a trend lock
Yeah,
application pipeline perspective?
one of the biggest things that's happened, I think, this year, in addition to the things everybody knows about the huge resurgence in DPA, is that on the government side of things, especially, well, two different things actually. One, on the government side of things, Ginnie Mae securities, of course, are FHA loans, VA loans, rural development loans, and Section 184 loans, to a much smaller extent, Indian housing loans. But there's been such a dramatic difference in prepayment speeds, refinance rates between VA loans and FHA loans. These 2 times we've had rates drop this year. VA loans are refinancing at 3 times and 4 times the rate of FHA loans on the very highest interest rate tranches. So there's been this huge breakout. And if you look at Ginnie Mae security prices, as you get to the higher coupons, the regular TBA, the generic price, it's not moving up hardly at all. In fact, you can look and like UMBS 7s, Fannie and Freddie 7s are 1.5 points higher than Ginnie Mae 7s, because buyers of those Ginnie Mae securities, they don't want the generic one. They want to have a security that's all small loan amounts that can't just refinance that quickly, or all FHA loans, or especially all rural development loans. USDA loans have a huge premium at the top end. So it's been really interesting. There's a lot of companies, I think, that they've just got it set up. VA loans on average are 50 points higher in credit score. They're 35 to 40% bigger. There's a lot of companies that especially specialize in VA, and as soon as they get to month number 9, if interest rates have dropped 0.5%, they're picking up the phone and they're going to lower obviously we're lowering the veterans interest rate, but it's had a big effect on those premiums out there in the securities market. You can't just say, well, here's the price for Ginnie Mae, here's what we're doing here. There's a huge difference depending on what kind of loan it is. And then in the Fannie Freddie space, there's, some people know this, some people don't know. And I'll talk a little bit about what guarantee fees are, because lots of people on the call, they know what they are, but they don't know exactly how they impact things. So Fannie Mae and Freddie Mac charge this fee every month to guarantee the timely principal of payment and interest on this loan against default. And for a long time ago, that was 25 basis points. And then it really got low during 2005, 2006, 2007, like 15 basis points. You could even do special deals and get it even cheaper than that. And Fannie and Freddie still made tons of money. And then slowly, once they got out of conservatorship, got into conservatorship, those started drifting up higher and higher. We're back to 25 again, 30, 35, 40. Now we have low level price adjustments, which are really just other ways of adding in guarantee fee that's up front. And now what's happened in the last, really since May 1st, these guarantee fees have slowly increased again, about another 6 basis points across the country. You can be a big lender, small lender, whatever it is. And it's really coming from, you kind of think, well, Fannie and Freddie are supposed to be competitors, right? And back when they were businesses, when they were corporations, they were competitors. They fought fiercely for volume. They still made a ton of money. And now everything really is it's all directed by FHFA. So Fannie and Freddie are saying, well, we need to capitalize more. We're doing mission score stuff. We're doing, very low income programs in this program. And so we need to be able to slowly increase these. So every month they're going up 1 basis point, 2 basis points. I'm hopeful that they've stopped now. But that's been something that's it's not easy for lenders to deal with, even though they're small and incremental. It's just a money grab from the American consumer. I mean, really, they could do a great job guaranteeing fee loans at 25 basis points. But now they get 50 basis points in guarantee fee, plus loan level price adjustments, and all that cost is just borne by the U.S. consumer, by households, and it's very unfortunate. But that's the trend we're seeing. There's nothing any of us can do about it, but that's the trend we're seeing out there.
Those are great points, and I've written about the guarantee fee changes that lenders cannot hedge against.
Right.
So you're sitting there with you're a Fairway or a Union Home or a UWM or whatever, with a pipeline of however many hundreds of millions, and all of a sudden the agencies jack up the guarantee fee, whether it's 1 basis point or 5 or 10, whatever. You can't hedge against that, and that's just a cash loss to you.
Yep, certainly.
Another thing that's important to remember too is this is in note rate. This is not like a loan level price adjustment, like a quarter point. G fees are in the 60s, approaching 70, I would argue now. That is note rate. I mean, that is just and again, I remember in my secondary days negotiating a 17 basis point G fee with one of the GSEs and being elated, and now they're, who knows what they are, but I think they're in the 60s, and that is, I mean, it's like 0.6 to every rate that's just going into the government's pocket. And I know the argument against privatizing Fannie and Freddie to this point, which I've agreed wholeheartedly with, is that it would, disrupt the markets and it would raise mortgage costs for people. But at some point, with G fees and loan level price adjustments, there's going to be a point where the private market would come in and offer a better takeout.
Yeah, that the spread between QM and non-QM certainly has been narrowing.
Brandon asked a question about if private investors have been doing the same thing. And the answer is yes, because every loan eventually, unless it's going into a bank or credit union's portfolio, is getting securitized with Fannie Mae, Freddie Mac, or Ginnie Mae. Ginnie Mae, by the way, Ginnie Mae's guarantee fee is 6 basis points. I know the loans are all insured, but Ginnie Mae does just fine with 6 basis points. Not sure why Fannie and Freddie need, 50 plus loan level price adjustments to be in the 60s, but they're supposed to be competing with each other. And right now they're competing on, on mission type stuff. They're not competing in price for share. And I don't think that's the way that market's supposed to work.
We had Stan Middleman on 6 or 7 weeks ago. I remember we were talking about Fannie Freddie, and he was adamant you need them because, they compete against each other. And that was kind of my counterpoint. I'm like, they're not really competing against each other. A couple of years ago, even they were a little bit. I know Freddie was a lot more aggressive than Fannie and acted as if they were competing. But right now, I see they're not. They're just one. It's all like, to your point, Chris. It's all just fueled by FHFA goals and targets that they're setting for them, and it makes their playbook the exact same. It has to be, if they want to meet how they're being gauged and judged by FHFA.
And it's the American home buyer who's paying for it.
It's the American home buyer, absolutely. that is, it's one of the really great untold stories, honestly.
That's why I brought it up. I mean, whether it's tariffs or G fee, it's always the consumer that gets it in the end.
Yep.
We have Mark Calabria is coming on the show. I think it's middle of October. I got him to come on. I'm really excited to talk to him, get his perspective on all this. He was very close to going down the, get Fannie Freddie out from underneath the government thumb, and then Trump lost in 2020. And of course stopped all that. If Vice President Harris wins, certainly Fannie and Freddie will continue to exist how they have. And I think she'll use them as vehicles to more aggressively pursue affordable housing goals and inventory, maybe even to a lesser degree. If former President Trump were to win, he probably would go back down that path, probably with Calabria once again as his FHFA head would be my guess. But what about J-Pow, Chris? Do you think, I know Trump was anti-J, he appointed J-Pow, then about 9 months ago, he talked some smack about him. Then a couple months ago, he was interviewed and kind of rolled it back and said he would bring back J-Pow. Of course, with Trump, you never know what to believe. But I mean, I think with Kamala, right, J-Pow would stay in the seat, barring some screw up these next couple months on what they do next week and November 7th. But do you think J-Pow survives Trump if he were to win? And how do you view that, Chris?
I think it all depends on Trump's come out there several times and said, that he thinks, he is against Fed complete independence. He says he thinks that whoever's in the White House should have influence over Fed policy, which makes a lot of level heads explode, mine included. That's what a horrific idea. So I think if Trump were to be elected, it would depend on what Jay Powell thought of his idea. Not that it matters, because you can't just universally do that. That takes congressional action. And I think there'd be enough level-headed Congress people that would realize that wouldn't be a good idea, because what about when their party's not in power? So, I don't know if I'm Jay Powell, I kind of, if as long as things get back to where they're supposed to be and you're in a good spot, I declare mission accomplished and make $25,000 a speech and go do whatever the hell I want, instead of being followed around all the time and constantly under the government's thumb. That's what I would do, and say, it's been a great run. I was the savior. I got us through the worst inflation since the 80s. And I'll see you on the speaker circuit.
And Greenspan still being alive, I mean, really is a testament to hanging it up. I think you're J-Pow. I can't believe he's still alive. I questioned if he was alive when he was still the Fed chair at times, but well, as always, the time flies when we have Chris on. And if you are unfamiliar with Vice Capital Markets, it's the hedge advisory firm I used for decades, and just a great outfit, and filled with great, smart, really thoughtful people. And Chris does such a great job running the company, and we appreciate you, Chris, for coming.
I appreciate you, Rich. Thank you. Really appreciate that a lot. Love
Group
being here with you guys. It's really just it's an absolute treat. So really appreciate it a lot.
Well, it's like the mafia. The only way out is debt. So we'll be tapping you on the shoulder in a few months here, probably after we get past the election. Would love to have you back on to get a refreshed perspective on all this madness that's been going on. So
sounds great.
Beautiful.
I think it'll be interesting to see if normally in the last several hundred years, you could count on the election resulting in the election result. Now, I mean, I think, hasn't Donald Trump already said, if I lose, I'm gonna, I can't lose. If I lose, I'm gonna, I don't know. Anyway.
Well, Rob, now that Taylor Swift is out there, are you ready to make your endorsement yet? I know you keep it close to the vest, but.
Well, the interesting thing about the Taylor Swift news was that supposedly 300,000 people registered to vote after her proclamation.
Really? Wow.
So that's a lot.
She's evidently pretty popular. So
yeah, so I've heard.
Well, good stuff. And want to thank Rob, as always, and our guest this week, Chris Bennett of Vice Capital Markets, for joining us. Thank you again, Chris.
Thank you. Really, my absolute pleasure. Have a great time with you guys, and a lot of great discussions too.
And to our attendees, you'll find this on podcast and the Chrisman Commentary YouTube channel in about 20 minutes from now. This is part of the Chrisman Commentary Network. Fantastic series of shows, one every day of the week, different topics and parts of the industry, and really great thing that Rob's son is building, and been pretty cool to see it happen. So
Let's hope my radiator doesn't spring a leak going through the Central Valley.
good luck with that. And to our attendees, yeah, we'll see you. We're live every Thursday at 3 p.m. Eastern, and we hope to see you next Thursday. And have a great rest of the week and weekend, everyone. And we'll check you next week. Take care.
All right.
Take care, everybody.